Good morning, ladies and gentlemen, distinguished guests, colleagues, and friends. On behalf of the Atlantic Council's Africa Center, I'm delighted to welcome you to today's important discussion about the future of U.S. commercial diplomacy in Africa and beyond. We are meeting at a pivotal moment. The global competition for markets, resources, and influence is intensifying. There have been tectonic changes in U.S. trade policy under President Trump, who asserts that trade, not aid, is the way forward. It is important to mention the tools beyond the words. That is why we are convening today. Does the U.S. have the means to implement its policy? MCC, AGOA, EXIM, DFC. Now that the aid tool, USAID, has gone, only the Millennium Challenge Corporation, Exim Bank, and the African Growth and Opportunity Act and DFC remain under review. The deadline for the authorization of the U.S. International Development Finance Corporation is also approaching. Today, however, we will also focus on the DFC with a report from our senior advisor, Aubrey Ruby, entitled DFC 2.0, a blueprint for a bigger, faster, and more strategic agency. Challenged by Adva Saldinger, she will, senior reporter at DIVEX, Aubrey will present the key findings of her report launched today on behalf of the Africa Center and the Policy Center for the New South. The Policy Center for the New South is the largest think tank in Africa and is run by Karim Al-Ainawi. I would like to thank Karim for our excellent cooperation. He is represented today by Ambassador Mohamed Lulishki, former ambassador of Morocco to the United Nations, among other prominent positions. Congress will also share its views on this announced commercial revolution. How can we ensure that U.S. tools of commercial diplomacy generate tangible benefits at home and for partners in Africa and Latin America? To address this, Senior Fellow Enrique Milan Meya from the Atlantic Council's Latin America Center will join the discussion. He's the author of a sister report on Latin America and DFC, and I would like to thank him and other distinguished guests for joining us today. Rob Mosbacher, former president and CEO, and also of the Overseas Private Investment Corporation. Ferid Belaj, Senior Fellow at the Policy Center for the New South. Elena Matza, Chief Strategic Development Officer at TechMed. We could not have gathered a better group of experts to reflect on these issues. To set the scene, I'm honored to introduce our first distinguished speaker, Olivier Rakotomalala, the Minister of Mines of the Republic of Madagascar. He has been at the forefront of shaping Madagascar's mineral and energy strategy, ensuring that resource development drives sustainable growth, attracts responsible investment, and supports local communities. His leadership is particularly relevant today as critical minerals, so abundant in Africa, rise to the center of global economic and security conversations. He is in Washington with his colleague, the Minister of Trade, and is being guided here by our dear friend, the Ambassador of Madagascar, Lantosoa Rokoto-Malala. I'm also happy to welcome her to the Atlantic Council today with her team. Please join me in welcoming Minister as he delivers his keynote address.
Ladies and gentlemen, good morning. So first of all, allow me to express our sincere gratitude for the invitation, even if it was just received yesterday night, and also your warmest welcome. We are here for this time for the AGOA negotiation, but this is a great opportunity to share what we can bring also to the business in the mining sector for the American investors. So our topic today is enhancing U.S. tools in growing to compete in growing global market in Africa and beyond. So if you talk about competition, we need to know who are our competitors. Then we need to know what is their approach, their strength, their weakness, in order to us to design the appropriate tools for these competitions. So, and also we need to know the ground situation, the real situation in the ground. So who are your competitors? Your competitors are the emerging countries, Asian countries, and other countries also, European countries. I take the example, for instance, the Asian countries, not only China, yes, of South Korea, India, and Turkey, and they are all very, very aggressive in their approach. So, like the case of Madagascar, we have lots of potential in terms of minerals, which interest almost all countries, the big countries, emerging countries. And these last couple of years, we updated, we modernized the legal frame to allow us to have a legal framework which will be appropriate for international investment and also to secure the investment. But we are still seen as a risky country. A risky country, that means that lots of investors, they are not really keen to take that risk because if we talk about mining activities, it's a long-term project and the return of investment might take sometimes decades. That means that we need a very strong legal framework to ensure this long-term security. But I'd like to tell you that if we take the case of US, US government has already set up some kind of tools that allowed to bring some social stability in the countries like AGOA. She was talking about AGOA just now. AGOA was a tools which allowed a country like Madagascar to create hundreds of thousands of jobs, which is equal to social and economic stability. It's like it represents like more than 50% of the workforce in the country. So, if you want to set up a tools, this kind of tools, it's very important in the given the fact that if you want to set up a long-term investment, you need safety, you need stability, and this kind of tools, I think it was very important. Second things, as I said in the beginning, the investors always see the country as a risky country. So we need some tools as well, some organization to do the risk assessment of the business in the country, because I know that even if we have done the modernization of the legal framework, it is not known by everyone. And we need some institution to accompany the investors to do the risk assessment. And also, as I said in the beginning, we have a very diversified mineral resources. They are all still at the potential status, but we need investment to transform all this potential into wealth. Who will bring the investment? We don't have. That's why we need foreign investments, but foreign investment needs stability, social stability, political stability, economic stability. So we have to take in account all these piece of puzzles to make to set up like environment of investment which is appropriate for a long-term projects. So I think if we discuss today about the tools, US tools, I think these three key points that I have talking about, I think it's very, very important. First is the modernization of the legal framework. which is, to align with the international standards. Second is the accompaniment of the investment, because as a long-term investment, this risk assessment, and also the investment itself, because it's most of the time mining investment is a very capitalistic investment and risky investment. So we need some accompaniment of these investments. I think the last point that I want to raise is the presence of the government, the support from the government, both government, Malagasy and American government, if is to ensure the investors to take this risk, because always, as I said, an investment where we have the return of investment, we will reach only after 10 years. Really, it needs some security, and without the government accompaniment, without some international institution accompaniment, it would be very hard for an investor to take alone that risk. I think I was given 5 minutes, so I think I've already reached 5, maybe even more. So it was really a good opportunity to share. I brought a map of roughly the potentiality in terms of mining in Madagascar. We are talking about critical minerals, actually, lots here in your country. Since 6 months now, we talk about critical minerals, and I'm glad to share you that we start to have some American investment in this kind of project, which is Energy Fuels, based in Utah. They have a mill there, and this is a project. If they took over an Australian project, that means that they have confidence on the legal frame in Madagascar, and we are very, very supportive of on all investment in the mining, and they can be the testimony of this support from the government. And this is, I think, one of the projects, because you want to be independent from China. Based, in terms of like monazite, for instance, the minerals that they will be working in Madagascar. 96% of the global market of these minerals is controlled by China, but this project in Madagascar is one of the project non-China based supply chain, but 100% US. So I think it's really very, very important that we have that kind of project in the long term, because as I told you since the beginning, that the competition is very, very aggressive, very, very aggressive, and they don't they bring like US tools. Is low, like USAID or AGOA or MCC, but for them it's like what do you need? You need roads, okay? Give us some mines, but we will build the road. So the approach we need to understand, and also, but the advantage of American tools is that it is the population itself will support the project, because of the large, there are lots of people benefiting from the US tools in the country, so it's already a very strong point for American investment in Madagascar. I think I have to stop. She's already there. I understand that she's there. So thank you for your attention, and please don't hesitate in the future. You have my contact. We can share more in the future if you need. Thank you so much.
Thank you. Thank you very much, Minister, for making the time today. As you are in Washington in the middle of important talks about trade and commerce between the United States and Madagascar, which is an interesting case study for us today as an opening of this conversation. As you know, we have a virtual audience. This is live stream on social media and on our website. So some of our guests are virtual. This is the case with Ambassador Mohamed Lulishki, who represents today the Policy Center for the New South, our partner. We organized this event with. He is the former ambassador of Morocco to the United Nations and a prominent figure at the Policy Center. Ambassador, over to you.
Thank you. Mr. Minister, Madam Ambassador Ramayad, dear colleagues and friends, I would like first of all to convey to you the greetings of the President of the Policy Center for the New South, Mr. Karim El-Ainawi, who is at this time attending a day event in the Ministry of Foreign Affairs, and he couldn't join us. So he entrusted me with the privilege to share with you some introductory additional remarks. The first question that comes to mind when one wants to address the topic of today is this one. Is the United States truly prepared to address Africa and the broader Global South as a strategic partner? Or will its engagement continue to be selective, instrumental, and transactional? Today, many African leaders and citizens perceive Washington's stand as one that sees Africa less as a partner and more as a theater for geopolitical competition dominated by security considerations, particularly counterterrorism. Development financing has been scaled back. Humanitarian assistance has been suspended in some regions of the continent, and trade policies too often disregard the specific socioeconomic realities of on the ground. Initiatives such as AGWA and the MCC have opened doors, but they have not established a genuine peer-to-peer partnership. Too often, they reinforce old partners exporting raw commodities instead of building diversified industries or excluding fragile states that most need support. By contrast, China has become Africa's largest trading partners, offering infrastructure at scale and with speed. And a few minutes ago, the Minister of Madagascar hinted also to other regional powers that have found established partnership with Africa. Competing head-on with China in this arena is not realistic, doesn't appear to be realistic, but the United States has its own distinctive advantages in forging lasting partnership with Africa. I would see, given the limited time that I'm allocated, I would see 4 critical areas. First, education. Africa is the youngest continent in the world. Its future depends on training systems that prepare young people for tomorrow's jobs. This is where US universities, institutions, and exchange programs can be transformative. Second, financial services. with the African Continental Free Trade Area creating one of the largest, if not the largest markets in the world, the United States can bring its unmatched expertise in capital markets and financial innovation to help Africa unlock real growth. Supporting financial integration will create opportunities for Africa and for the United States. Third, trade policy. A rethinking of trade policy could significantly enhance US-African relations. One promising avenue would be the adoption of cumulative rules of origin across African economies in their trade relations with the United States. This would incentivize inter-African supply chains, deepen regional integration, and strengthen Africa's engagement with Washington. It's a smart way to align US trade policy with Africa's own ambitions. Fourth and last, digital transformation. From mobile payment to AI-driven agriculture, Africa's digital revolution is already underway, but major gaps remain in infrastructure, in governance, and in skills. And here, the state has a unique advantage. Targeted investment in connectivity, data governance, and digital innovation can accelerate Africa's progress while also demonstrating America's commitment to shared technological prosperity. The time has come to see and treat Africa for what it is, a dynamic, essential partner in shaping the global economy of the future and the future of the world. If the United States leans into its strengths and attractive fundamental values, it can help build a partnership grounded in trust, real partnership, and solidarity. A partnership that advances prosperity, not just for Africa, but for America and the rest of the world. Thank you.
Hello, my name is Adva Saldinger. I'm a senior reporter at DevEx, and I'm here with Aubrey Ruby, and we are going to dive right into talking about the U.S. International Development Finance Corporation. This is a pivotal moment for DFC. We're less than a month from the deadline to reauthorize this institution that was created with the BUILD Act during the first Trump administration to really create a more robust U.S. development finance institution. It is able to do debt investments, equity investments, political risk insurance. Last year, it did upwards of $12 billion in investments, over 181 investments, and it was really starting to push the upper limits of its total portfolio size. So now we're faced with this reauthorization. This is an agency that so far appears to be, a piece of this administration's foreign policy moving forward. So tell us a little bit about the significance of DFC, how it fits into this conversation about US commercial engagement, particularly in Africa.
Thank you, Adva, and thank you to all who've tuned in today and who are going to read this new report. The Development Finance Corporation is core to US commercial engagement abroad. No major OECD country or even the emerging economies operate without a development finance institution. It's there to help de-risk projects that are seen to advance US strategic interests and development desires of our partners. And its tools, whether they be equity investment debt, political risk insurance, which is its origin from the 70s when OPIC was created to deliver political risk insurance in markets that didn't have any. These tools are just as important today, even if not more so. And so the DFC is core. It's very central to this administration's ability to achieve its policy goals. and to advance commercial diplomacy by supporting investment in key sectors. So the DFC reauthorization process is an important one. And as you and I have discussed, there's broad bipartisan support for the DFC. There was in its creation and in its evolution to become bigger and better. And in fact, when I wrote this report, I had some challenge because usually when I set out, feel like I have a lot of maybe even controversial things to say on a topic like tools of U.S. commercial diplomacy. But in this case, there are quite a few areas of agreement between the administration, between different congressional legislative initiatives, and among us in the kind of think tank space on what should be included.
So why don't we get into some of those? And I think just one piece of context, right? So we're under a month now. We're really at crunch time. I think from the people I'm speaking to, I don't think we're going to see a full reauthorization in the next few weeks. I think we're going to get a temporary extension of DFC, and then we'll sort of see, hopefully by the end of this year, calendar year, a more robust proposal. But as you mentioned, there is a lot of agreement on some of the key issues, right? People want to make it bigger. They want to more than double the amount of money that it can invest. What are some of these other key issues that are sort of at the heart of some of these proposals?
Yeah, I think they're core in terms of bigger, which is a larger lending cap, right? It's at 60 billion. It went from 29 to 60 when the BUILD Act was created and OPIC went to DFC. They're hitting above that, right, or around that right now. So remember, that number is not how much they can actually put out. It's the outstanding liabilities of the portfolio. So you can imagine that if you look at it over across a portfolio, you can hit that number. So there's numbers from 100, 200. The administration put 250 billion for that cap. So that's the bigger part. The more flexible part is about which countries the DFC can operate in. Historically, it's been able to focus on lower middle income, and we're at the Africa Center. That's been important in our space because that's meant African countries have received kind of the lion's share of, the majority share of DFC project finance and transactions. However, there is a need to change that to be more flexible to include middle-income countries, particularly if this administration wants to do critical minerals deals because, say, and we're going to hear from our colleague in the Latin American Center later, but many Latin American countries that are mineral rich, think of Chile and copper, and are in the middle-income category. So more flexible in terms of where it can operate, and then better and sharper tools, particularly on trying to solve a problem that's plagued DFC from the beginning, which is how does it get more equity to invest? So that's been at the core, and everyone agrees there's a need to fix the equity problem, and there's all kinds of minutia on what's causing that equity problem, but there's just a question of how it's fixed.
And I think that's at the heart of it, right? There's some agreement on these big things, but there's sort of differences in how to approach some of this, or differences in exactly, do you expand to upper middle income countries? Do you also include high income countries? Do you include guardrails around how much investment can go to those sort of higher income countries to sort of preserve the lower and lower middle income focus of the institution? Because that's something that I have heard from people, right? Does this remain a development institution or more of a commercial institution, foreign policy, or national security?
Yeah, if it's investing in Japan or investing in France, the question is how is that money catalytic or additional? Because you in that case might be crowding out private sector investment. So, I think there has to be some thoughtfulness around, where the DFC operates, even if it has a very wide over and flexible mandate. So that's an area of, not contention, but just discussion, I would say.
Absolutely. So we talked about sort of some of the proposals that are out there. In your paper, you have some sort of unique additional things that you think could be considered. So why don't you tell us about a few of those? Because some of them I think are quite creative.
Well, one of the challenges DFC's had since its creation is that it has a small staff relative to its mission and relative to its financial capacity.
And that's been
Since the beginning.
strained
Yes.
even more this year with
Correct. They went
staffing
down from
challenges.
about 750, as I understand, about 500 now, headcount. And if you look at that even relative to, we're not thinking competition with China, but thinking relative to European DFIs, it's very, very small in terms of human capacity. So one of the things I've been arguing for some time is that DFC should create, almost advisory council, private sector advisory council, where you can take senior, people who have retired from decades in a particular industry, whether it be mining or semiconductors, something, or data centers, something that's very strategic to the U.S., and you could have them based in various U.S. cities, and help the DFC do, deal origination, do networking to the right co-investors, do, assessment of deals, and, to work on a volunteer basis. I think we have a lot. Americans are the most volunteering of any OECD country. More Americans spend time volunteering in their lives, and we have a huge number about to retire in the baby boomer era, and I think many are motivated on patriotic things, so we could recreate some kind of advisory role for a cadre of volunteers that could be very meaningful for DFC. And it would solve another problem, which is that here in Washington and in this room, many people know about the DFC, we talk about it, but if you're in Seattle or Chicago, many people have never heard of the DFC. And there are thousands and thousands of companies in the US that are medium-sized businesses, doing over $1 billion in revenue and those kind of things that might be fit for middle-income country investment or emerging market investment, but they know nothing about the DFC. So if we had prominent people based in different cities to help, coordinate a roadshow and things of that sort without any cost to the US taxpayer, I think it would be a unique and exciting development.
One of the challenges DFC has faced is also that they have a very small footprint abroad, right? And that makes it hard to source deals. I think that's exacerbated by the fact that they used to lean heavily on USAID employees to help with that pipeline. So you also have a proposal that would sort of try to address that.
Yeah, I mean, again, I think the same idea of having a volunteer kind of advisory corps within the U.S. could be applied to finding a new way to reinvent the Peace Corps of sorts, like a deal corps. I know Rob Mosbacher, who will join us on the panel shortly, has been promoting a biz corps for a very long time, but find a way to have young MBAs who are trying to work off their debt, student debt, and combined with volunteers, just like the business folks that I've said, work in emerging markets for 1 or 2 year stints, and work in and out of our embassies. And of course, as this administration pushes through its commercial diplomacy efforts at State Department, I think the commercial orientation to our embassies will be helpful, but that doesn't mean they have like MBA type skills to look for deals. So I think that's an interesting idea. I think a lot more co-location and secondments to help just deal with some of the challenges of interagency coordination. But I know we're going to talk about that in the panel, and I hope everyone gives feedback to this report. And thank you, Adva, for being. If you don't know, she is the best reporter on all things DFC in Washington. So follow her work, because that's where I learn about new DFC developments and look for all the scoops. So thank you for this conversation, and I welcome my panel to join me on stage and virtually to have this conversation. I don't think they were touched, but. Do we have our... Okay. Well, welcome everyone. And thank you so much for taking time to join this discussion. I think we all come at this conversation from a variety of standpoints. And I think, Rob, I would like to start with you. You have not only been a leader in development finance from your leadership of OPIC, but present at the creation of the BUILD Act and have been engaged with the DFC ever since its creation. And we'd just love to give your thoughts on how development finance can be used by the U.S. to advance U.S. national security and competitiveness, and how you see a bigger and faster and more efficient DFC playing in the next coming years.
Aubrey, thank you very much. You've already touched on a number of areas that I think need strengthening. And one of them, for instance, is the agency needs to be much more proactive than reactive. Historically, it's always been basically customer driven by who shows up at the door and asks for help from the DFC. We have to be out aggressively promoting opportunities to work together. And that means we need much more of a physical presence in strategic areas and strategic sectors. And you can't get that overnight by just trying to hire your way into it, although I think clearly the agency needs to significantly increase its field capacity or business development capacity. But one great way to do it is to partner seriously with like-minded financial institutions. So with respect to Latin America, teaming up with IDB Invest, the private sector arm of the Inter-American Development Bank, they have people in every country in Latin America and the Caribbean, and they have very, very impressive deal intelligence, market intelligence, capacity for building pipelines. So teaming up with institutions like that in Latin America and Africa would be hugely beneficial. Second, the agency definitely needs to take more risk. The name of the game here is how do we de-risk projects so that we attract much more private capital. And the agency has been very, very conservative on risk for years. And we have to change that culture of being risk averse into one of being very creative, risk worthy and willing. So that's another area. You touched on the importance of more flexibility in terms of countries in which they could operate. It is, first and foremost, the DFC is a development agency. It should remain a development agency, but it always has foreign policy implications. And we can, I think, bridge that gap between foreign policy imperatives in middle and upper income countries with the predominance of focus on middle and lower income countries. That really was the initial influence. One last observation I want to make. Nimble. The agency is way too slow in how it processes deals. And we're losing businesses, unfortunately, who simply look at the DFC and say, I can't wait that long to get a deal done. So it needs to be much more nimble. Next, it needs to be much more simply organized. It needs to reduce the involvement, I think, of multiple layers of decision making. So, the old saying is, the Chinese show up with their checkbooks, the Americans show up with their notebooks. We can't afford for that to continue. So I'll just stop there.
Thank you, Rob. And Enrique, I want to bring you in. Rob teed it up with the partnership with the Inter-American Development Bank. Any thoughts from a Latin American perspective on priorities for DFC reauthorization?
Absolutely, Audrey. And first of all, thank you very much for having me here today, and congratulations on your report. And also congratulations to the Africa Center for organizing this type of events. Well, in the case of Latin America, I think adding on what Rob has mentioned, it's very important to partner with regional multilateral development banks. IDB Invest is a very good option, but I also want to mention CAF, the Latin America Development Bank. And CAF has a caveat that is the only multilateral bank in Latin America where the US is not a main partner. So that gives the flexibility to move forward and also to reach local deals, and also having the workforce that Rob was mentioning and you were mentioning before, the importance of being in every single country to identify good deals and good opportunities. For Latin America, the DFC reauthorization is very important because it aligns with many of the America's first priorities in terms that the US should invest in critical supply chains that are strategic for the US. In this case, Rare earth minerals are key, especially the case of cobalt, lithium, but also copper, but you can also include traditional minerals like gold that very recently, one case to mention is the Dominican Republic has become a very important source of gold for the world, and without mentioning other countries. And secondly, and most important, is the opportunity for finally the US invest in infrastructure in Latin America. China has a big footprint in infrastructure in Latin America, and it's strategic infrastructure, meaning seaports and airports. So right now, DFC could have the opportunity to invest with a big equity in this type of projects where China has been dominant and where it's critical to change the narrative of China being the first trade partner of many Latin American countries, and the US can become once again the first trade partner.
Thank you, Enrique. And I think those partnerships with regional organizations are important. Fareed, I would like to get your view on that from Morocco and your background. One of the things that the DFC has tried, but I don't think has worked to the scale possible, is partnering with African development finance institutions. We do see positive movement around that with Lobito and the Africa Finance Corporation. But there's been less operational cooperation with the African Development Bank as there's been with the Inter-American Development Bank. So any thoughts on that topic?
Yes, no, thank you very much. First, I would suggest that while partnering with regional financing institution is important, but we also should not discard global ones like the World Bank. Yes, that's my background, but I still believe that it's very important to have that complementarity between global and regional. And it is very important to have that because institutions like the IFC can help in partnering with DFC in order to, make the cost of capital that is today really prohibitive for Africa, more of an engine. Development finance here helps to bridge the gap by offering long-dated concessional or risk-sharing instruments. And I'd like to go back to what Rob mentioned earlier in terms of making sure that there is a level of risk-taking that is absolutely fundamental in this kind of business. DFC equity should go and back up guarantees, or blended finance, and make sure that you can open up to other ways of finance that make actually the American engagement as unique as it should be. For instance, when people start talking about China, the US and DFC must, embrace what makes it different. The temptation to see, for instance, the Belt and Roads Initiative as something to copy or to outbid is, in my view, a losing proposition. The truth is that the US cannot and should not try to mimic BRI's models or state-led, debt-heavy, often opaque financing. This is not America's comparative advantage. And this is where the DFC can be credible in offering quality, transparency, partnership. And while BRI, for instance, again, is fast, true, and Rob, you're absolutely right. They are fast. They come with a check. But it has often left countries saddled with unsustainable debt, poor quality construction, limited local value add. And this is something that we experience today. So DFC's offer can be differentiated by bringing in pivotal capital, applying rigorous standards, and ensuring that projects deliver lasting benefits. And I really believe that this is the angle that the US, through DFC and others, should be taking.
Rob, would you like to comment on that? You've worked very hard on transparency issues. We've both worked together on that for DFC and development finance institutions globally. Would you like to comment on this effort that some have, seeing the DFC as key to being our version of Belt and Road, and trying to, build infrastructure abroad and the critical minerals space? Any thoughts on that?
I think Farida's absolutely right. We can't compete with them dollar for dollar. We shouldn't even try. We should play to our advantages, which are quality and transparency and doing business with the United States. I have never met someone in any one of these markets who said we'd much rather do business with the Chinese than the Americans. Now, they may say we had to do business with the Chinese because they're much quicker. They sign a deal and they're off to the races, and you sign a deal and it's subject to all these things. So we have disadvantages in a sense in terms of we have processes which must be followed. But generally, I think we need our own version of sort of a proactive marketing of U.S. involvement in helping build infrastructure and not try to mimic Belt and Road. Yeah.
So Helena, maybe I'll come to you because, TechMet is such an example of, a fund that's come out of the DFC's cooperation. And, what's been your experience and how do you see DFC operating in these markets as you guys are on the front lines?
Yeah, look, it's a great question, and so much of what's covered already is really leaning into what the comparative advantage of working with DFC can be. So, for us, DFC investment has allowed us to do so much. We've been able to invest in more projects, accelerate that development, and find ways to crowd in additional capital, whether that's other sovereign lenders or private financing for a portfolio that is quite diverse, right? We have 10 portfolio companies, half of our MPVs in the US. That's not really subject to the DFC financing, but it frees us up to look at the rest of the world in a different way with the US expressly, but also in a politically implied way with us. And it's allowed us to be a little bit more, risk takers, right? And so when the US-Ukraine Investment Fund was announced and we saw the first PSA process for the Dobra lithium project, we felt confident that that is a process we want to participate in. And, DFC is a special piece, not just for TechMet, but the whole development apparatus, right? Because I think the point that was made that we glaze over sometimes is that investment in a private company that allows us to move forward the development of a critical mineral project or any project that's, high capital intensity, that takes a long time, is debt that's not on the balance sheet of that country that we're working with. And that's why I have a lot of views on using the whole USG toolkit as we enter into new markets that are, from my former life. But DFC is the kind of critical piece that allows that to really be part of the economic development story, both at home and back in our market when we're working on national security.
And could you give an example, say, in Africa that you've invested in from TechMet, and maybe one in Latin America?
Sure, I'm happy to do so. So, we have two really important investments in Africa right now. One is in Rwanda, it's our Trinity project, and then we have another one in South Africa as well, a rare earth project with Rainbow Rare Earths. And both are totally different, but absolutely instrumental to the story and development agenda that we're working on, and allows us to test out different technologies. And now, as the REEF process is continuing in the DRC and Rwanda peace process, we see an opportunity to look at our operations in Rwanda and potential market entry in DRC in a completely different way. And then, of course, in Latin America, in the case of Brazil, the work that we're doing with Brazilian nickel, while the whole nickel market is under this extreme amount of distress, we have this asset that's continuing to move forward that's on, the lowest quartile on cost and emissions, right? A really important addition that we hope to bring online quite soon to that narrative, and obviously looking for offtake to come to America. So in a moment where lots of companies are shuttering their projects, we are, it's not all sunshine and rainbows, but we're definitely persevering and looking at, what does that footprint look like in Brazil and beyond.
And then how do you think we could have 10 more TechMets? What would it take for DFC to do that? What would the private sector need to do?
Yeah, so I think there's a couple elements to it. Many of the things you outlined in your report, I think are absolutely instrumental for DFC. Parts of the ways we had success when I was in the government in Lobito Corridor was because we tested that model of a proactive approach, crowding in other regional lenders, right? So in the case of Lobito, we had AFDB and AFC $1 billion of continent-led finance at the table. And we also worked with the other institutions in the US government system, whether that's TDA, XM, others, to really build an apparatus of investment across multiple sectors that ultimately was really important to leverage critical mineral investment, some of that happening totally naturally now that we had more investment in the essential infrastructure, energy, rail, ports around it. So I do think that theory of the case, where DFC is really at the center of that, is a really important model to help others move forward. From the private perspective, I think the thing that's unique about TechMed, and to see more TechMeds out there, is that we designed our whole portfolio to be in that alignment, right? And so we don't have a separate fund that is Western aligned or ex-China. TechMed operates that way through and through across our assets and our trading platform. Now, that's a tall order to ask, and DFC will have to use its own assessment if that's totally required for every partnership that they pursue. But it has been really our business card out there in the world that working with us isn't just being close to the USG because we have that equity investment, but because of that transparency we carry out across our whole portfolio. So I think that will be an essential piece as we see new funds and permanent capital structures come together.
And I think the equity that DFC did put in was very, very important for signaling to other investors. And so I do want to come as we kind of close out our conversation to say to each and to say what your priorities would be if you were suddenly queen or king of DFC and you could make all the changes you wanted on authorization process, kind of what would they be? Maybe Fareed, I'll start with you, and just thoughts on what you would do if you could shape this.
Well, maybe two things. One, in terms of the discourse and the message. I really believe that the message should be that what DFC is doing and what U.S. aid in general and engagement are doing is for U.S. interests. So we need to move away from this awkward idea that this is charity, benevolence, etc. It is for U.S. interests. So that can percolate with those who are making decisions, notably on the budgetary side. Secondly, and taking a kind of an example from what the World Bank has done over the years, we need to be, or you need to be, DFC need to be more decentralized. Regional hubs, say Johannesburg, Nairobi, Casablanca, Bogota, Sao Paulo, being closer to where the action is, closer to where the clients are, and build that kind of a very, I would say, fleshy relationship with your interlocutors, so that you can really deliver what they need and understand what they need, and frankly, be able to stave off the competition that is looming large in all of these countries.
Yeah, Fareed, there is no substitute for proximity. I think one of the reasons why the Inter-American Development Bank partnership has worked so well is because they're blocks away from each other in Washington. Enrique, maybe I'll come to you next.
Thank you, Aubrey. I think a couple of things to mention here. The first one is I rather prefer to analyze projects than countries, because you can get biased when you analyze particular countries because of many standards to determine that measurement. But I think they're very good projects, and especially in Latin America right now, they're very good projects that align with the America's first priority. The second thing, and I completely agree with Rob, is that DFC needs to be more flexible, more agile, and needs to be closer to the deal. So I think if they add those two things, probably we can see big changes in the Latin America-US relationship in the finance development side.
Helena.
So I think we did a lot of chatting about how we can improve how deals are generated on the ground. But I do think that making sure that national security imperative is at the top is really important, and that that's clearly articulated so DFC and other agencies in the USG know what they're looking for. And frankly, whether that's congressionally authorized or just practice of the administration, work more closely together. So they're crowding in USG resources around similar projects with the aim of serving whatever that national security imperative is, whether that's access to critical minerals or you name it. So I think those two elements will be really important to see in addition to many of the things you listed in your report.
Yeah, I've said this many times and I continue to believe it. We are a messy federal democracy. Interagency coordination and collaboration will always be the bane of our existence. It's super hard. But if you do make it known from the top that here are our collective priorities, and if those priorities stay the same over time, I do think you can have a little bit more coherence just from that kind of marching orders aspect. Rob, I'd like to come to you and specifically, you know, we've all talked about the need for a culture change to take on more risk. Culture change is hard to do. I mean, you led this organization in some way. How do you think we can get there? And then what would you like to see in the reauthorization process happen? And what do you think is possible in the near term?
Well, actually, the one thing I'd like to see would be much more willingness to take on greater risk and to be creative about it, not foolish about it. To change the culture, though, you really need, I think, the Congress to be in your corner. In other words, I think the Congress has to tell the agency that we recognize that the only way to mobilize much more private capital, which is the only way we start to close the gap in terms of needs versus resources, is through more creative risk-taking that will bring private sector players in off the sidelines. I think the Congress needs to tell the agency that it values creative risk-taking. I think the agency actually should look at compensating people who are willing to take creative risk, in other words, rewarding them. Today, you know, if you take too much risk and something goes off the rails, your concern is you're going to be on the front page of the newspaper, get hauled up in front of Congress. We have to get over that. And we have to actually embed in the reauthorization that with greater risk-taking comes a high probability, if not at least possibility, of loss. In other words, some projects are going to go south. And so we need to sort of rewire the relationship between the agency and some of its constituents to be much more risk tolerant and, frankly, rewarding risk creativity.
Yeah, I almost joke that, you know, at least for a period of time, the mandate should be to lose money. And until you make that a mandate and have everyone march towards, you know, higher risk and catalyzation and monitor people and reward people based on how much private capital they mobilize or catalyze, then I think it's very difficult. People operate off incentives, and the incentives to continue to go back to Congress every year and say, we made money for the Treasury, may or may not be aligned to a nimble and aggressive DFC. Well, thank you all for taking time today. This conversation is certainly not over. We are in reauthorization season. It happens to correspond to funding the government season. So there are some real trade-offs being made on Capitol Hill in terms of what's taking the time. If we are not able to get the full debate on reauthorization in the next 3-4 weeks, hopefully that we have an extension and can do that towards the end of the year when hopefully the government is funded. So I think it takes all of us and takes our voices to be heard, and partly why we're writing reports and having events. So we welcome collaboration with others that want to see this as a robust tool of U.S. foreign policy. So thank you to my panelists, and thank you to everyone who's joined online today.